Season 4, Episode 2, Capital Has Jobs. In the last episode, we introduced a different way of thinking about portfolios. Instead of seeing them as collections of investments, we began to see them as machines designed to convert capital into outcomes, stability, growth, income, optionality. And like any machine, the system works best when each part is doing a specific job. That brings us to the first principle of portfolio design. Capital has jobs. Most investors never think about capital this way. They think about opportunities, a promising company, a growing sector, a fund that has performed well, a strategy that sounds compelling. Each investment is evaluated individually. But when capital is treated only as a series of opportunities, something subtle happens. The portfolio slowly becomes a collection of unrelated decisions. Each investment may make sense on its own, but together they don't necessarily form a system. And when there is no system, the portfolio begins to feel unpredictable. Not because markets are unpredictable, though they certainly are, but because the structure itself is unclear. Imagine building a house without deciding what the rooms are for. You start constructing walls, you add doors, you place windows. Each element might be well built. Each decision might seem reasonable. But if you never asked what the rooms were meant to do, the house would slowly become confusing. Is this space a kitchen? A bedroom? A hallway? The structure would exist, but the purpose would be unclear. Portfolios often develop in exactly this way. Investments accumulate, but roles are never assigned. When we say capital has jobs, we mean something very simple. Every dollar in a portfolio should have a reason for existing. Not just an expectation of return, but a purpose within the system. Some capital exists to grow. This is the part of the machine that expands the system over time. It captures innovation. It participates in the long arc of economic progress. And it allows the portfolio to become larger and more capable in the future. Growth capital is patient. Its job is not to support life today. Its job is to build the capacity to support life later. Some capital exists to generate income. This part of the portfolio has a different responsibility. Its job is to produce cash flow that can support spending. Over time, this income becomes one of the most stabilizing elements in the system. Because when income arrives, regardless of market headlines, behavior changes. Investors become less reactive, less anxious, less dependent on predicting the next market move. Income capital is not about maximizing yield. It is about creating dependable coverage. Some capital exists to provide stability. Markets move. Economic conditions change. Uncertainty is unavoidable. Stability capital acts as the shock absorber of the system. It reduces the pressure placed on the rest of the portfolio during difficult periods. Its job is not excitement. Its job is resilience. And its quiet presence often prevents investors from making their worst decisions at the worst moments. And finally, some capital exists to preserve optionality. Optionality is the ability to act when opportunities appear. Markets occasionally offer extraordinary moments. Assets become deeply undervalued. Entire sectors temporarily fall out of favor. Optional capital allows investors to respond without destabilizing the rest of the system. It creates freedom of action. Without it, even obvious opportunities can become difficult to pursue. When these jobs are clearly defined, something powerful happens. The portfolio stops feeling like a collection of investments. It begins to feel like a system, a structure where each part supports the others. Growth builds future capacity. Income supports current spending. Stability absorbs shocks. Optionality creates flexibility. The machine begins to work. But when these roles are not defined, the opposite occurs. Growth capital may be forced to support spending during a downturn. Income capital may be chased for yield and become fragile. Stability may disappear entirely. And optionality may be lost because every dollar is already committed. When that happens, the portfolio begins to depend on favorable market conditions. And systems that depend on favorable conditions eventually fail. The key insight here is deceptively simple. Before deciding what to buy, decide what the capital must do. Jobs first, assets second. Because once the roles are clear, the choice of investments becomes far easier. The machine already knows what it needs. In the next episode, we will explore another idea that often surprises investors. Most portfolios are built around percentages: 40% here, 20% there, 10% somewhere else. But percentages are often the wrong way to think about portfolio design. Because portfolios are not really about percentages. They are about load, how much work each part of the system must carry. And understanding that difference changes how portfolios are built.